So I'm Andy Prosser, I'm the Head of Investments at InvestEngine, and I'm joined today by Rory. Rory, would you like to quickly introduce yourself?
Yes, thanks Andy. So my name's Rory. I work at JP Morgan Asset Management. I've been there for the last 10 years, working in the International Equity Group.
Perfect. So let's get into it then. Let's talk about your REI ETFs. Now, people will have heard of ETFs before, but what is an REI ETF?
So an REI ETF, sadly, is not the REI ETF. It's the Research Enhanced Index ETF. And these products actually have a very long history at JP Morgan Asset Management. We've been managing products in this way since the late 80s in the US. But what's been the real excitement, particularly for me over the last 10 years, is packaging these products in an ETF. And what these are strategies that are designed to look, feel, and behave like traditional passive ETFs from a top-down level, but we're using research insights from our fundamental team of research analysts to try and outperform the benchmark. So these are actively managed ETFs which look and feel very similar to traditional passive ETFs that many of your investors will be used to using.
Yeah, that makes sense. I think one of the big differentiating factors of these kind of ETFs versus your more traditional active ETFs is their low cost. So what is the advantage of having such a low cost range of active ETFs?
So the advantage is that any alpha that we generate or excess return we generate on top of these ETFs, if the fees are too high, then guess what? All of your excess return is taken away by that fee.
Yeah.
So being able to keep these fees very low allows investors in these ETFs to capture more of the excess return that we're trying to deliver.
Yeah, that makes a lot of sense. And I noticed that they've got quite a low tracking error. So it might be useful for viewers to understand what is tracking error and why are they designed with such low tracking error.
Yes, exactly. So these products, we've got a range of them. They're typically looking for about 1% tracking error. And tracking error is a measure of how different a product is versus the index. So if you're used to traditionally very active strategies, perhaps in a fund format, these will have tracking errors of 3, 4, 5% and beyond versus the benchmark. A passive product, if it's doing its job perfectly, which is to track the index, will have 0% tracking error.
Yeah.
So 1% puts it in the active range, but at a very, very low level. So what that means is you have products which behave very, very similarly to passive indices. But again, we're using these active insights to try and outperform just at a much lower risk level than you might expect from an actively managed product.
Yeah, that's great, thank you. Now these are also ESG ETFs, is that correct?
Yes, that's right.
Yeah. So what does ESG stand for? What does it mean? And how is that incorporated into the kind of stock selection process?
Yeah, so there's a number of different ways that ESG is incorporated into these products. And the first is exclusions. So we exclude thermal coal, controversial weapons, and tobacco from these ETFs. The second is the integration into our research. So I spoke a little bit already about how we use research to try and beat the benchmark in these products. That research comes from our fundamental team of research analysts who are based all around the world. In their sort of role, in their job, they're trying to forecast long-term earnings for each company. A really important part of these forecasts is how ESG issues impact earnings. So ESG is integrated into our fundamental research process. The third way and final way that ESG makes its way into these products is through engagement. So we host regular engagements with the companies we invest in to talk to them about ESG issues.
Yeah, and we touched a little bit there on the stock selection process. How do the JP Morgan team figure out which stocks are undervalued and which are overvalued and how to skew the portfolio?
Yeah, it's a lot of work, as I'm sure you can imagine.
Yeah.
So these 90 research analysts that we have are career research analysts. So their job is to research individual companies. We divide it by region and then by sector. So typically these analysts cover about 20 to 30 stocks each. So it's really sort of intense fundamental research. What they're doing is they're essentially coming up with a buy list of stocks. What are the stocks they like the most and what are the stocks they like the least? It's then the role of the portfolio managers in these REI ETFs to construct portfolios which again look, feel and behave like the index, but we overweight stocks that the analysts like the most,
Yeah.
and we underweight stocks that analysts like the least. So that's how these sort of active fundamental insights make their way into these REI portfolios.
So digging a bit deeper into the kind of stock selection process, obviously we're in for a bit of a turbulent time this year. We've got elections happening all over the world. How do these REI ETFs adapt to these global market uncertainties?
So the real beauty of these products is when we think back to the tracking error that we use, we try and ensure that as much of the tracking error as possible is dominated by stock-specific risk as opposed to macro risk, region risk, or sector risk. So in theory, these are sort of quite neutral to macro risks and things like the election, uncertainty in the marketplace versus your traditional passive ETFs. But the real benefit of these products is we can use the fundamental research insights to try and position ourselves in names that we think are more likely to outperform. So particularly in years like this year, where it's a lot more volatile, there's a lot more uncertainty, there's a lot more dispersion across stocks and views, that's a really exciting time for these products to try and capture some of that alpha.
And in terms of who these products might appeal to, what sort of investors might be investing in these products? And second part of the question, how should they be used in a portfolio? Are they more of a core holding or a satellite position, or can they replace both?
Yeah, so I think the benefit of these products, again, is just how versatile they are. So at the beginning of our conversation, I referenced how we launched these products in the late 80s as sort of strategies, but we packaged them in an ETF vehicle just over 5 years ago. Historically, these products really were just used for big institutional clients. So the sort of evolution of these products has been making it available to a whole new spectrum of investors who invest in ETFs. So looking at our ETF business, we have institutional investors all the way down to retail investors. How they use it, to the second part of your question, typically is as a core holding. So use these products as a core holding, and then you can have satellite positions around that. And again, that comes down to what these products are set out to do. These should look, feel, and behave like the traditional indices many of your investors will be used to using, but we're trying to use some of this fundamental research to add alpha on top of that.
Interesting.